Jobless claims just out moments ago. The number 255,000. I think I'm blushing. The expectation was for 270,000. So that was a considerable miss as far as jobless claims for the latest week. Take a look at where the futures are as they react to this number coming out just a few moments ago. Dow futures up 79 points. We had been up triple digits. Then we got a miss on the Goldman Sachs earnings report, that weighing on futures, but not a whole lot of reaction to this jobless claims. Let's bring in Jeff Bucher from the Registered Investment Advisor, Bucher, I should say. Thank you for joining us this morning. What do you make of this, this jobless claims report out right now? Do you make anything of it at all?
Well, just in general, the economy just experienced, the U.S. stock market, the worst quarter in the last 4 years. So investors are a little probably wary and worried about where this is all heading. And so all of these economic data kind of drive where fears and some perceptions lead. And that obviously is reflected in the price, which, there's two types of value, the true value, and then you've got the speculative value. And those types of numbers can certainly manipulate the price. All
right. We also got CPI numbers out showing a big decline, a notable decline because of the drop in gasoline prices. I just wonder, bigger picture, how this is all going to play into the Fed's next move, following up with Peter Barnes' report.
Well, commodities, the oil, those types of investments have been very tricky over the last year. And it's really, when you look from a diversified investor situation where they're looking for exposure in different things, the oil prices have certainly hurt portfolios in many ways, not just directly in the oil prices, but also obviously the companies related to oil. The energy industry in general is limping along because of that. And again, as investors look to diversify a portfolio, it makes it pretty tricky.
Hey, Jeff, it's Mike Murphy. Looking at these numbers that are coming out this morning, definitely not gangbuster by any means. But if you were in the camp that the Fed should raise rates, I think there's nothing here that's really changing your mind so much. And probably, though, if you were in the camp that they shouldn't raise, there's nothing really that I'm seeing in these numbers so far that really is going to sway someone in one direction from one side to the other. Do you agree?
Yeah, they're kind of in a quagmire because they've said they're going to be raising rates and they haven't yet. And I think that a general consensus would say at some point rates are going to go up, but it's going to have some impact on other types of investments. And so I think the challenge for the Fed is where to take it from here with all the new data that's coming out at them.
Hey, Jeff, you're managing wealth for a living. You've got to tell people what to do on a daily basis. There's a changing political environment on the horizon with 2016 coming up. A lot of uncertainty out there. Overall, should the average American, the average working American, be buying U.S. stocks and believing that the U.S. stock market will keep going higher?
Well, I think every investor should have some exposure to U.S. stock. Now, depending on your goals and needs, that would determine what percentages we're looking at there. The political environment right now is very challenging. A lot of divisiveness on Capitol Hill, but then we've got the election coming up. But U.S. stocks are certainly still a viable area. If you stayed completely out of U.S. stocks over the last several years, that wouldn't have been a wise decision, as they've been the best asset class in general. So we all always need to have some asset class, some exposure to U.S. stocks. The question is, how do we do that? For those that are getting close to retirement, a more diversified approach, maybe index funds, things that have a more broader spectrum might make a little more sense than trying to pick individual stocks where sometimes we might hit a home run, but sometimes we might strike out. And so the key is building an overall portfolio that's healthy in all markets, not just in particular cycles.
Jeff, we're running a banner right now that Social Security benefits are not going to increase next year. This is the third time in 40 years that this has happened. Is this going to change the investment outlook for the average American?
Well, I've been saying recently that the most important election of your life is actually your Social Security election. For many people, it's their largest asset, and many times it's neglected. And so when we're seeing a time like today, or in these last several years where there's been many zeros in the cost of living adjustment, it certainly makes it more challenging because we might have to rely on our portfolio a little heavier. So we might need a little more growth.
Let me add to this. This is a story in the Wall Street Journal, but you have no cost of living adjustment in Social Security, which, by the way, this was expected. But you have about 1/3 of elderly people, of retirees in Medicare Part B that could face a premium increase in Medicare for 2016 of 52%. Congress and the president, they can't figure out a way to stop it. But again, it puts pressure not only on the individual and their spending, but it also, there's a lot of headline risk in these drug companies, with Valiant being under investigation for these price increases, in any healthcare provider potentially in the next year.
To add to that point, these are people, elderly people, who have been relying on interest from bond portfolios a lot to really finance their living. And we've seen interest rates down near zero, so those people are really the ones who are getting hurt by interest rates staying at zero.
And we're literally seeing, and we've already begun to see it earlier this year, a repeat of what happened leading up to 2008 and 2007, where older people, retirees, were taking excessive risk that they didn't understand. It was in the bank stocks with the dividends back in 2008 that just wiped some people out. This year, it's been master limited partnerships. It's been even in high yield. People have lost money, and they're putting these high yielding investments, and they lose their shirts.
All right. We want to thank Citizen Advisory Group President Jeff Bucher for joining us this morning. Also, Jeff, thanks for weighing in on that breaking news.
All right. Thank you.
All right.